The housing market is showing serious signs of stress.
I like to say it's a hurricane over real estate right now. We're in the Category 5 hurricane.
Some experts are even predicting a black swan event in real estate very soon. I'm going to explain a lot of the headwinds facing housing that nobody's talking about. And at the end of this video, I'm going to reveal how far prices could go down. I'm going to do this in 3 simple, fast steps. Step number 1, let's go over housing market price dynamics. In other words, what makes prices go up and what makes them go down. Well, everyone knows that we got to start off by talking about supply and demand. But it's not just supply and demand in and of themselves. You can't compartmentalize supply and compartmentalize demand. You have to look at the relationship between one another. Let me show you what I'm referring to. Let's look at a chart going all the way back to 2002 to today's date. On the left, we go from 0% up to 250%. This black line represents CPI, the official headline inflation number given to us by the government. The red line indicates home prices. Now, these are nominal prices, and we can see in this chart how high prices went relative to the inflation rate, let's say in 2006. And everyone knows what happened then. Once we hit 2006, prices went all the way down and didn't go back up until 2012. Well, what happened here? Okay, well, a lot of you would say, well, there was excess supply and everyone was building a house and all these liar loans. But at the core of the price movement, what happened is demand dropped relative to the amount of supply. And you'll notice that prices were, let's say, at 100% where they were in 2002, and inflation was nowhere near as high. In other words, the home prices went up a lot faster than the rate of inflation. And another way to look at this is we have to understand that wages, incomes, usually go up with the rate of inflation. Now, it is true, when we get severe inflation, like we've seen over the last couple of years, incomes do not go up at the same rate. But usually, if inflation is going up slowly, incomes stay right around the same level. So if we look at the prices and see the delta between the CPI, effectively what it's telling us is that there's the same delta between prices and incomes. But let's fast forward to what we see today, where it's obvious, just looking at this chart, that prices are much higher relative to incomes and the CPI than they were in 2006. So what I always say is, if we were in a bubble back here, what are we in right now? Are we in a healthy housing market? And the rebuttal that you'll always get, well, it's supply is tight. We're at historically tight supply, and therefore the prices make sense. Okay, but what you're doing is you're taking the recent past and extrapolating that indefinitely into the future. And I think this is a huge mistake. Let me show you what I'm referring to specifically. So this is a simple chart, and the blue line represents demand, the red line represents supply. So you can see, even in a market where demand is going down significantly, you can still have prices go up if supply is going down at a faster rate. But the question becomes, what happens when supply goes back up? Especially considering the fact that demand is being exhausted. It's almost gone. Why? Because the affordability is just completely out of reach for most Americans when you consider the prices and the interest rates. But the key takeaway from this little chart is to realize that although prices are up, demand is down, and it's way down. So now let's think through how prices are actually set in the real estate market. This is interesting. So let's just assume for a moment this is the entire housing stock in the United States. So these homes, or at least the housing stock that is not currently for sale. So right now we've got about 140 million homes in the United States. And let's just assume, for the sake of this example, we'll keep things super simple, that the entire housing stock is just, 3, 6, 8, 10, 13, 14. And 13 of these houses are not for sale, but one is. So if there's only one house for sale, you don't need much demand. In fact, demand can go way, 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 way down, and still prices will go up. Well, how will the prices for all these 13 homes go up? Because they're based on the comps for this one house. In other words, prices are set at the margin. So let's say this one house sells for $200,000 based on current demand, which is incredibly low. Well, what happens if one more person sells their home? So instead of one house being for sale, now we have two homes for sale. Well, you'd say, George, well, the price would probably go from maybe $100,000 down to $75,000, maybe down to $50,000 if there's only one buyer, but now he has two options. Okay, well, that means that the entire value of these other 13 homes would be cut in half. They would go from 100,000, or let's say 1.3 million, because we've got 13 homes, all the way down to, let's say, 650,000. So now that you understand the concept, let's go over some real numbers. Right now, in the housing market, we have 140 million homes, roughly, like I was saying earlier. Only 650,000 of them are for sale. And you say, well, George, okay, give me some context there. How many are normally for sale? 1.2 million is the normal when you go back to 2019. So let's just think this through for a moment. If prices are right here, based on 650,000 homes being for sale, where would prices be if we had 1.2 million homes for sale? Answer: way, way lower. And that's a technical term. You'll only hear that on the George Gammon channel. Oh, but wait, there is more. Most of you know from watching the news lately that there was a crypto company called FTX, run by Sam Bankman-Fried. And they had a token called FTT. And what's interesting, and most people aren't connecting these dots, but I'm going to reveal it to you right now, is their FTT token, which was effectively a Ponzi scheme, was very similar to today's real estate market in the United States. Now, I'm going to explain why, but before I do, let me go to a quick clip from an incredible video done by YouTuber James Janney that explains exactly what was happening with the Ponzi scheme with FTX and their token FTT. Editor, let's cut to the clip.
On July 29th, 2019, FTX launches their token coin called FTT with a total supply of 350 million, most of which was owned by Alameda and FTX. The launch was a success. I mean, by August, the price of FTT rose to $1.81, which made FTX and Alameda's supply of FTT tokens worth millions of dollars, just like that. Magical internet money, right? But that's not the real stroke of genius here. You see, the truth is, since they were the majority holders of the token, they could never really sell all of it. I mean, the price of the tokens would completely crash if they tried to do that. No. But what they could do was point to their FTT tokens that are valued in the millions of dollars and use it as collateral to take out loans, or to simply say, oh, look how much we have in assets, even though part of that is really just FTT tokens whose value is mostly tied to speculation. It's almost insane to think about, but it worked.
So what you had are these FTT tokens, and the majority of them were in the back pocket of Sam Bankman-Fried, or Alameda. Just like the majority of the housing stock, 140 million, is not for sale. But what they did is they took just a few tokens and they sold those. So the float was very, very low. Does that remind you of anything? A very low float, just like we see in the housing market. And even though there wasn't that much demand for these FTT tokens, because there were so few of them, the price of all the other tokens that Alameda or Sam Bankman-Fried had went to the moon. And then what were they able to do? They were able to borrow against basically the equity they had in their home, just like people are doing right now. But once FTX was forced to sell some of those tokens, what happened to the price? It plummeted. And it's the exact same dynamics that are at play right now with the housing market. Step number 2. So now we've got to figure out what would prompt someone, or what would force someone, maybe better said, to sell their house, which in turn would increase the supply of homes for sale and take us right back to the dynamic we were talking about in step number 1. And a lot of people would say, oh, that's impossible because people have such a low fixed rate mortgage that they're incentivized to never sell because now mortgage rates are a lot higher. But what you're assuming there is that people will choose not to sell. And my argument would be people might not have a choice. Let me show you exactly what I'm referring to. We're going to go to a recent article about Airbnb hosts in New York. Now, you might not have been following this story, but what has happened is New York City has come out with a lot more regulations that effectively have banned Airbnb. So all of these hosts are coming out and saying that this is going to absolutely destroy them financially. Let's look at what this article is saying. A decade of unfettered growth had made hosting something between lucrative side hustle and a full-time job for thousands of people in the city. And I'd like to remind you that if this is going on with thousands of people in New York, this is going on with millions of Americans across the country. More on that in just a moment. In a marathon 7-hour meeting in January, hundreds of them slammed the Office of Special Enforcement for abandoning working class New Yorkers who would struggle to pay their mortgage without the cash infusion Airbnb brought in. So you see what happened is all these people that had to make ends meet saw Airbnb as an opportunity to do that. So starting especially in 2020, 2021, 2022, they went out and bought these homes that if they leased them for 6 months or a year, they would be cash flow negative. But since they're able to lease them or rent them out nightly, they're able to charge a much higher rate and therefore they have positive cash flow. But you see what happens when you take away the nightly rate and you add on a 6-month or year-long rate. Now, all of a sudden, they don't have any money coming in. In fact, they have negative cash flow, and this puts them into a position where they are forced to sell. Here's a direct quote that's exactly what I'm referring to. Being able to occasionally Airbnb my home has enabled me to make my mortgage payments. End of quote. The article goes on to say, hosts argued the regulators would financially ruin them and force them to take drastic action to make ends meet. In other words, sell their property. Now, a lot of you may be saying to yourself right now, okay, George, I get the whole thing with Airbnb, but are these regulations, they only apply to New York? That's where you're wrong. We're seeing these regulations pop up all over the United States. In fact, not just in blue states, but red states like Texas. So this is really a nationwide problem that nobody's talking about. And I assume the next rebuttal or the next objection would be, well, George, I get what you're saying, but Airbnb, I mean, it's just a couple people here and there. It's not really going to move the needle. I understand how it might increase the supply for sale above that 650,000 mark that we talked about in step 1, but so what? The amount of homes go from 650,000 for sale up to 651,000. Airbnb can't have that big of an impact. Fair enough. Let's go right over to InsideAirbnb.com and let's look at New York City as an example. All of these orange dots, and by the way, all of the green dots are Airbnbs. In New York City alone, there's almost 40,000 listings. Just think if even half of those listings were forced to sell. What would happen to the real estate market? What would happen to the prices of all the other homes of people that didn't sell? Let's just say those people that are sitting there with a fixed rate mortgage. So they're going to sit on their house. They're never going to sell. Okay, well, that's fine. But your equity will do the exact same thing that the FTT token did. Now, it's true, it's not going to go down to zero, but it's going to be a lot less than it is right now. And for a lot of people, that could put them into a position where they have negative equity. And therefore, if the unemployment rate goes up or if something else happens, they're going to be forced to sell. In fact, they might even be forced to give the keys back to the bank, very similar to what we saw during the GFC. But this percentage of Airbnbs in a market could be something that's exclusive to New York City. I don't think so. Let's go over to Austin, much lower population, but we can see that there's 14,000 Airbnb listings as of right now. Look at all these orange and green dots. Just think if even 10 or 20% of these people were put into a position where they might want to keep their home, but they don't have a choice. They're forced to sell because they can't afford the mortgage payments. And let's just assume for a moment that they don't have these onerous, draconian type of regulations in some place like Austin. And by the way, they're rolling them out in Dallas as we speak. But this also assumes that the occupancy rates that these people need to make their mortgage payment is going to stay consistent. All right, well, what happens if we go into a recession where the probability is very, very high that the occupancy rate for hotels and travel across the board go down? Well, it's the exact same thing. These people are put into a position where they have to sell. And if they do, then that makes the supply of homes for sale skyrocket relative to the amount of homes that are currently for sale. You see, if we were in a normal market where there was 1 or 2 million homes for sale, this Airbnb problem might not move the needle. But because the supply is so tight, an additional 250,000 homes that are coming on the market as a result of what's happening with Airbnb is going to impact the overall price for the other 140 million homes dramatically. But the story doesn't end there. Let's go right over to the San Francisco Fed's website. And we've used this article in a few whiteboard videos lately, but it's worth going back to again. And this was August 16th, 2023. They did a study. And they talked about the accumulated savings during the cerveza sickness and how the majority of that savings will have been depleted in Q3 of 2023. Our study showed that households rapidly accumulated unprecedented levels of excess savings, defined as difference between actual savings and the pre-recession trend. Relative to previous recessions, our analysis suggested that some 500 billion of the 2.1 trillion in total accumulated excess savings remained in the aggregate economy by March of 2023. Our updated estimates suggest that households held less than 190 billion of that 2.1 trillion, I'd like to remind you, of aggregate excess savings by June. There is considerable uncertainty in the outlook, but we estimate that these excess savings are likely to be depleted during the third quarter of 2023. And this is consistent with the Fed data on the labor force participation rate, which you can see has gone up dramatically. Why? Because people are running out of money. They're running out of purchasing power. And if they're running out of purchasing power, that means fewer people are going to be able to pay their mortgage, even if they have a low 30-year fixed rate. And oh, by the way, let's remember that Jerome Powell, as we speak, is trying to increase the unemployment rate. Editor, let's cut to the clip.
Reducing inflation is likely to require a sustained period of below-trend growth, and there will very likely be some softening of labor market conditions.
But not only is Jerome Powell trying to increase the number of Americans that don't have jobs, therefore can't afford their mortgage payment, let's remember that there's a high probability that we go into a recession at the end of this year or into 2024. And if we look at a chart of recessions and the unemployment rate, what do you think happens? Look at each one of these shaded areas. The blue line represents the unemployment rate. And even going back to 1950, you can see that every single time we get one of these shaded areas, in other words, a recession, the unemployment rate skyrockets, as you would imagine. Shocker, right? In fact, during the GFC, The unemployment rate went from around 4.4% all the way to 10%. So think about that for a moment. Let's just assume that going into 2024, the unemployment rate goes from 3.8%, where it is now, up to, let's say, even 7 or 8%. What would that do to people's purchasing power and their ability to pay their mortgage? In other words, how many additional people out there would be put into a position where they have to sell their house? They don't have a choice. And again, this is at a time when the existing homes for sale are very, very low. Therefore, if you have a tsunami of homes coming onto the market that are for sale, that's going to make prices plummet. And I know many of you are probably saying, well, George, I've been listening to the news, and the news is talking about how we're not even going to have a recession. There's not even going to be a soft landing. There's going to be no landing at all. The economy is on fire. Okay, fine. Let's go to the New York Fed's website, and we can see that based on the calculations of the New York Fed, it's not George Gammon talking, this is the Federal Reserve. I always like to point that out. I'm not making this stuff up, guys. The probability of recession predicted by the Treasury spread is now at 70 or just under 70%. And you can see that it's much higher than it was even prior to the GFC. So this is a very interesting chart. It compares the '06 bubble with the 2022 bubble. And this blue line represents the price increase from 1991 to '06. And you can see it got up to about 109, our starting point in the index 0, of course. But then look at 2012, 2022, it goes up much, much faster to a point where we were in 2022 at 174. And then going back to '06 to 2012, prices declined by 50%, but that took 6 years. But look at the price declines lately. We're down 16 points, which is interesting because you see the black line went up a lot faster, meaning the bubble from 2012 to 2022. But it looks like prices are also going down a lot faster than they did from '06 to 2012. But if this turns into the pervasive psychology with the average American that they believe home prices will be lower in the future, then this could also, in addition to everything that we've talked about in this step, produce a tremendous amount of additional supply, especially in percentage terms, because the current supply for sale is so low. Step number 3. So how low will prices most likely go? Well, this is actually a very easy question to answer. Back in step number 1, you'll remember we used this chart going back to 2002. But editor, help me out with this one. Let's use this exact same chart, but go all the way back to 1950. And what you'll notice right off the bat is that home prices usually just go up with the rate of inflation, which makes a lot of sense because that's what wages tend to do as well. So if you have quote unquote normal, historically normal interest rates, which by the way we do now, the rate on a 30-year fixed rate mortgage right around 8%, which if you look back over the past 100 years is right around the average interest rate, then you would expect for home prices to be right around inflation as well, because that's what they've been going all the way back to 1900. We could take that 1950 chart back another 50 years and you'd see the exact same dynamic. So in the future, we should expect for prices to normalize. Just do what they've been doing for the last 100 years, for heaven's sakes. And that's go right back down to the rate of wage growth. In other words, the rate of inflation. That means prices go from here down to there. And for those of you who are doing the quick math, that's about a decrease of, let's just say, 40 or 50%. But keep in mind, this is in real terms, and this is key. We could have nominal prices stay the same for the next 5 or 6 years, but if the rate of inflation is 5, 6, 7, 8% over the span of that time, then you could see prices in real terms go down by that 40% number, which would take us right back down to their historic norm. Another key that I want to point out is this is always a slow grind. Real estate never ever crashes. Even in 2006, at the height of the bubble, it took 6 years to get to the bottom. Now, it is true, prices are declining a lot faster now than they did back in 2006 and 2007. So could we get to that bottom point a lot faster? Yes, but it doesn't happen overnight. Instead of 6 years, it might be 5 years or 4 years. But the real estate market is not like the stock market. You're not going to have a Black Monday type situation in the real estate market where you wake up after a nice weekend on a Monday morning and home prices are down by 20%. But the main takeaway here is you've got to expect home prices in the future to come back down to their normal levels based on fundamentals. And that means home prices in real terms, when you adjust for inflation, down by around 40%. For more content that'll help you build wealth and thrive in a world of out-of-control central banks and big governments, check out this playlist. Right here, I will see you on the next video.